Welcome back. As we can see, options give traders some huge benefits other investment vehicles cannot provide. Traders often start off with stock or another investment type, and then later graduate to options when they think they're ready for more involved investing. There are several reasons why educated traders eventually make the jump to options. They offer the highest return on capital, maximizing an investor's dollar. They allow investors to decide on their desired probability of success before putting on the trade, in essence, allowing traders to set their own desired risk tolerance. And finally, options allow traders to define their risk versus reward. By doing so, a trader can pair options together, capping their profits in exchange for limiting their losses. This type of control and flexibility is not possible in other investment vehicles. For those who are interested and want to make above-average returns, options allow them to do so. However, it comes at a cost. Options are not easy, at least at first. They require plenty of studying and experience. For those who have a desire to learn, they will all start to make sense and pay off very soon. Moving on, you have heard me talk about return on capital throughout this course. But what exactly is return on capital? Return on capital is the percentage that represents the amount of profit gained against the total investment size. It's calculated by simply taking the profit and dividing it by the investment. Return on capital is important because it shows how much an investor can earn for every dollar they invest. For example, if we bought an investment property for $300,000 and then that property generated $24,000 of rental income a year, we would have a return on capital for this investment of 8%. This same analogy works in option trading. If we make a trade that has a max profit of $1,000 and a max loss of $4,000, the investment bank will hold $4,000 in order to secure payment if this trade goes bad. If we hold this trade to expiration and are successful in reaching our max profit, our return on capital is going to be 25%. If we instead decide to buy the trade back early and only profit $400, our return on capital is going to be 10%. Most new investors have no idea what a good return on capital would be. If we bought this trade back a few weeks before expiration, we might have only made $400. So would this have been a good investment? Let's go back to our property example. There was an 8% return on the whole year. Did you think that was a good investment? At OptionsStrategiesInsider.com, our average trade length is only about 30 days. So if we were to annualize our 10% return over a year, that would be an annual return of over 120%. So I think a 10% return over 30 days would be an amazing return. Even a 3% return monthly would add up fast over the course of a year. Just to give you some idea, if we invested $1,000 today and received a 3% compounded monthly return on our money, we would more than double our money in just 2 years. In this example, exactly 2 years from our investment date, our $1,000 would now be worth $2,032. The point is, as an option investor, there's no need to be overly aggressive. In fact, that's how most option traders get in trouble. We're happy to be making 1, 2, or 3% a month, and then every once in a while have a month where everything goes right and we pull in a much higher return. Over time, this turns into a lot of money. If you're getting excited about options, that's great news. But before you rush out and buy a bunch of calls or puts, there are certainly some negatives that come along with participating on the buy side of an option trading strategy. In the last lesson, we ran through some examples of investors looking to buy options and why they might want to do so. But for there to be a buyer, there also has to be a seller, which is just someone who is willing to take on the buyer's risk. Insurance companies normally perform this function in society. However, in the investment world, you don't have to be a big-time insurance agency like Geico or one of the many others to sell insurance. Anyone can do it, and for any size they feel comfortable with. The option seller takes in a premium in exchange for insuring the buyer's investment risk. The key to being a successful insurance agent, aka the seller of options, is to take on the best possible insurance situations. Car insurance agencies consider a lot of different factors when selling insurance. the person driving, the type of car, the miles driven per year, just to name a few. They then come back with a price that justifies their risk. Option sellers can do the same thing. Look at a company's fundamentals, understanding management, market perception, implied volatility, as well as many other possible factors that go into calculating if the risk warrants the reward. But why would anyone want to sell options when that comes with limited profits? And oftentimes, those profits are smaller than the max loss of the trade. That's a good question, and what's typically going through the head of most new option traders about now. Think of it like this. A car insurance company like Geico takes in many people's small premium payments, and every once in a while they have to pay out. But overall, they end up taking in way more money by selling insurance than they pay out to the people buying insurance. There are so many insurance companies today because the ones running their business intelligently are all making money hand over fist. The same goes for selling option premium. Those who do it intelligently will make money. I want to run through another example, except this time we'll be selling. But before we do that, I want to talk about calculating our break-evens. You may have noticed what our break-evens were on our previous examples, even though we didn't talk about it specifically. But before we run through our sell-side examples, let's discuss. It's very simple to calculate a break-even on an option trade. If we buy a 50-strike price call for $3, the stock has to reach $50 before we start making any money. But we still have to account for the $3 premium we paid for the option. So, easy enough, we simply add the premium to the strike price. Once the stock reaches $53, we've made a $3 profit on the call option, which covers the $3 premium we paid for the contract. So in this example, $53 would be our break-even. The break-even is calculated the same for both the buyer and the seller, except they're on opposite sides of the trade. If the stock finished right at $53 on expiration, this would be a tie, and both the buyer and seller would break even. Above 53, and the buyer would turn a profit and the seller would lose. Below 53, and the seller would win and the buyer would lose. Puts work very similarly, except we simply subtract the premium from the strike price to calculate the break-even. If we bought a 50-strike price put for $3, we would start making money once the stock trades below $50, but we would need to make up our $3 premium. So we would not reach a point of profitability until the stock reaches $47. With that said, let's take a look at stock ABC, which is trading at $45. If we believe it will not trade any higher over the next several months, we can sell a 50-strike price call 3 months out for a price of $4. The most we can hope to make on this trade is the $4, which is what we sold the call for. If the stock stays under $50, we'll in fact make the $4 we had hoped to. For every dollar it trades over $50, we lose $1. Of course, we were paid a $4 premium to take this trade, so we wouldn't start to take a loss on the trade until the stock penetrates $54, our break-even. For every dollar it trades over $54, it would be a loss. Let's now take a look at selling a put option. Like the call, the put option works the same way, but on the downside. Let's look at stock ABC once again, only this time we think the stock is going to keep moving higher. We decide to take a relatively aggressive approach and sell at the money put option, which means selling a put that has a strike price at the same level as where the stock is currently trading. We'll go 3 months out and sell the 45 strike put for $6.50. If the stock does continue to go higher and stays above $45 like we hope, our profit would be $6.50. Now, let's first figure out our break-even. For every dollar the stock trades under 45, we lose $1. We make $6.50 right off the top from the sale, so our break-even will be $38.50. As long as the stock doesn't trade under $38.50 in the next 3 months, this will be a winning trade. For every dollar ABC trades under $38.50, that will result in a loss of $1. All right, that concludes our lesson on learning the basics of calls and puts. If you've made it this far, then you're well on your way to learning the key fundamentals of option trading. Just be sure to keep watching, because we're going to show you far better ways to trade options than what you've seen thus far. There's a lot more to cover, so make sure you understand everything we've covered thus far with the quiz below. And I look forward to seeing you in the next video.